Adam Kummel. I manage our shareholder activism product at Bloomberg. We're talking about cross-border activism here. So that means not just U.S. investors who are interested in non-U.S. activist campaigns, whether they're incorporated or headquartered, domiciled in another country, but also non-U.S. investors. What should they know about U.S. laws? What surprises them? So let's give a couple of introductions before we start. I said let's start with introductions.
Introductions. Oh, sure. My name is Chris Ludwig. I'm the head of shareholder advisory at Barclays.
I'm Michael Partridge. I'm a partner at law firm of Goodmans in Toronto, and I practice in the corporate securities and M&A area with a significant amount of shareholder activism, both on the company side and on the activist side.
All right, so let's start with what do American investors need to know about, and when I say investors, I mean activist investors, need to know about running activist campaigns in Canada and overseas?
So why don't I start? Canada is an interesting place from an activist perspective. It's obviously very familiar ground in a lot of ways. We have very similar legal and political systems. Obviously, language isn't common other than a few boots and A's maybe that you'd have to work your way through. And so from, interestingly, Canada does not have a lot of sort of domestic-based, purely activist funds. So we certainly have lots of institutional investors that will engage in activist activities where it's appropriate, but we really don't have an equivalent to a Starboard or an Elliott in Canada. And so particularly for kind of large cap names, when you see activist initiatives involving Canadian companies, it very frequently is a Starboard or an Elliott or another US-based activist who has noticed an opportunity in a Canadian company and wants to take advantage of it just the way they would with a domestic company.
Is there an institutional reason behind that?
It's just a small market, and there's not a ton of capital that gets allocated to activist-specific only strategies. So there's a lot of kind of long, short, or general funds that will engage in that type of behavior, and there's some smaller pockets of capital that are dedicated to that strategy, but there's just not enough money in big pools that are exclusively focused on that type of activity. It's sort of the nature of the market more than anything else. So often when we are involved in activism situations, whether it's on the activist side or on the company side, there's frequently a U.S. activist fund who's part of the mix.
So I'm sure those U.S. funds are well advised sometimes by you, but what surprises them? What do they sometimes not know about Canadian rules?
Well, there's quite a bit. I mean, as I said, there is a lot of general familiarity. Our corporate and securities laws are often modeled on those that were developed in the U.S. And so many of the general concepts are similar, like you can't solicit proxies until you've mailed a proxy circular. The way shareholder voting works is very similar. We have fiduciary duties for the board that are modeled on what you see in the U.S. But when you sort of scratch below the surface, there are a lot of important differences that can drive different results and different strategies if you're not really aware of them. And so I've got my top 10 list of things that are different in Canada that might surprise or
all right, let's hear them.
Or an investor might want to be aware of. So I'll go through these very quickly. So first of all, disclosure. So Canada has a 13D type disclosure system, but the disclosure threshold is 10%, it's not 5%. And the timing is different, so that the disclosure, depending on the circumstances, is either immediately or it could be as late as 10 days into the month after the month in which the position was accumulated. So both in terms of where you hit the disclosure threshold and when you have to make the disclosure itself can be much different than what you're used to in the U.S.
I won't stop you on every one, but right. Given this is probably one of the major ones here, it's why you listed first. Do you think that U.S. investors, how aware of that are they? Do they generally go in knowing that, or are they sometimes surprised?
They're sometimes surprised, particularly if it's their first initiative
Okay.
in Canada. But even if they're not, if they're coming to an activist situation, eventually, it's probably something that they've become aware of just in the day-to-day of their managing their disclosure obligations with respect to their investments. So if they're starting to build a position in a company, they will presumably want to make sure they understand at what point do they have to start making disclosure in Canada. And so sometimes you already have that understanding just based on the steps you were taking to build a position. But sometimes people come in and say, we want to start doing something, and they're, I guess from the investor's perspective, pleasantly surprised that they don't have to disclose as early as they might have had they been doing the same thing in the U.S.
All right. Okay, sorry, go on.
No problem. So the next one, which a lot of people do know about, is the ability to requisition meetings in Canada. And so you don't have to be sort of bound to the AGM cycle quite the same way that you do in the U.S. And so any shareholder who owns 5% or more of the outstanding stock has the ability to require the company to hold a shareholder meeting at any time. How that plays out in practice is sometimes not as great as it sounds on the surface, and there's lots of things the company can do to slow down the meeting itself or time it in a way that's more advantageous from the board's perspective. But the ability to make that requisition can be an important tactical tool, even if you don't ultimately end up having the meeting ultimately held. Canada does not have mandatory universal proxies. They are available and they're sometimes used on a voluntary basis. But as of now, and this may change at some point in the future, particularly what's happened in the US, there's no requirement for companies to use universal proxies in contested meetings. We have true majority voting, so companies who are listed on the Toronto Stock Exchange, the senior exchange, are required to have majority voting for boards. It's kind of the typical majority voting that you're used to seeing, where you've got to step down if you don't get a majority of the votes in favor of the director, but there are some exceptions that allow people to stay in exceptional circumstances. Our federal corporate law has recently changed so that those companies have what we call true majority voting, which is, it is just if you don't get the majority votes, you're off. There are no exceptions whatsoever. And so for activists who are looking at vote no campaigns as a kind of a quick and dirty way of trying to make change without having to go the full distance with a proxy contest, companies that are subject to that requirement are interesting targets now. We have proxy solicitation exceptions that you don't have equivalents for in the US. So an activist can solicit proxies from up to 15 shareholders in Canada without having to have prepared or mailed a proxy circular. So if you've got a concentrated holding of stock in a particular name, you may be able to very quickly and easily get the support you need to succeed at a meeting without having to incur all the proxy solicitation expense that you would normally expect in the context of a normal campaign. Advance notice requirements exist in Canada, but they are much narrower from the company's perspective. For whatever reason, ISS has different policies when it comes to advance notice policies in Canada than they are in the US, and particularly when it comes to the type of information that nominees are required to provide. You're basically limited in Canada to whatever our securities laws require to put in this proxy circular about that person. You can't send them the 50-page circular asking them every detail about their background. And so the company's ability to resist nominations is much narrower in Canada than you would typically see in the US. We have something that's called the oppression remedy, which is, there's no analog for this in US law. It's an equitable remedy that's sort of a cousin to fiduciary duties. And what it says is that stakeholders whose legitimate expectations or interests in a company who have been unfairly disregarded or prejudiced can actually apply to court for an equitable order remedying that behavior. And because it's an equitable remedy, there's a lot of flexibility in terms of what that court might actually require to happen as a result of the behavior. And so we've seen this used in conjunction with advance notice nominations, where shareholders have said, if you don't accept my nominees, notwithstanding technical defects, we think that that's oppressive to our legitimate interests, and we're going to ask a court to require you to put them on your ballot. So it's because of the breadth of the remedy, it can be an interesting tool that's used in all kinds of different circumstances. We have dissent rights, appraisal rights, that are very similar to those in the US, but what we also have is a line of case law that says there's a strong presumption that in the context of an arm's length M&A deal, whatever was put on the table by the buyer is the fair value. And so your ability to sort of get more than that in the context of a transaction is pretty constrained. And it's going to be a very limited set of circumstances where it'll be ultimately worth your while to pursue that to the very end. The role of our courts and regulators in these circumstances can be sometimes surprising. They get much more actively involved, particularly the courts and even the stock exchanges in some circumstances. So activists will often have a multi-pronged litigation strategy where they're making complaints to the TSX, to the securities regulators, and to the courts, seeking all different relief, but all flowing from the same set of circumstances. And then finally, our proxy materials are not subject to advance review or sign off by our regulators, which is something I would recommend to you guys, because having to go through the SEC review process for your proxy materials is always a bit of a painful process, and we don't have to go through that here. So that's my list of reasons why, if you're involved in a situation in Canada, you've got to call us, because sometimes companies and their advisors go into Canada thinking the playbook that we use in the US will translate exactly, and that's very rarely the case, and you can sometimes step in it if you're making those types of assumptions.
All right, thanks. Chris, do you have a top 10 list for every country in Europe?
I don't have a top 10 list. I do have some questions for Michael, though. I lived this advising Rio Tinto with TRQ last year, and a lot of those items came up. The one item I think is interesting to start with is how the Canadian regulators stepped in during the pendency of a deal. Mm-hmm. We had gone and actually cut a deal with the activists to get the deal over the line in advance, and had to deal with the regulators. I'm just curious your view. We don't see that here.
Yeah, no, it happens quite frequently, and TRQ is Turquoise Hill,
Yes,
which is a large copper miner in Mongolia, which Rio Tinto owned 51% of, and they'd made a bid to buy out the minority. And so there were a number of issues that came up in that transaction. And you're right, the courts got involved, and ultimately the securities regulators also got involved and exercised, what's known as public interest powers to address issues that they were not happy with that technically didn't breach any securities laws. And so everything that was done in that transaction was by the book, according to what the law says. But our regulators have kind of this public interest power that says if you're doing stuff that we think is abusive to the capital markets, we have very wide discretion to step in and take steps to rectify that. So that was a big issue. And I don't know if you want to go through some of the sort of details of the deal.
Well, I was going to hit on one other item on your list.
Okay.
The special meeting, as a corollary to the UK, for example, we just advised Danaher with ABCAM, and the founder of ABCAM was going to call an EGM. And what that did is it basically attracted a lot of other activists, such as Starboard. How do you view that in Canada? You made some commentary there about there's some issues around it, and it's relatively difficult, but do you view it as much of a hammer as you see in other jurisdictions? Or?
I think it does put a lot of pressure on the board. And even, as I said, even if the meeting doesn't ultimately proceed, which is often the case, either because the company resists the requisition or tries to set a meeting date that is well off into the future and beyond the date that the investors would like to see something happen, the mere fact of that process having been initiated is often the catalyst for more meaningful settlement discussions, because now the company really knows it's on the clock effectively, and things are going to come to a head at some point. So it is a helpful tool from that perspective. But on the other hand, many times activists are disappointed that the meeting itself likely is not going to be held on the timeline that it would have otherwise liked to see. And sometimes, the horse is out of the barn by the time you get to the point where the meeting's actually going to be held.
I think straying from the list a bit, activity in Canada is up well over 100% year on year, as Adam knows, I'm sure. And what we're seeing is a lot of American investors almost stepping out, folks like Starboard and Cora at Algonquin. Are you hearing that chatter as well with your clients or from the legal side?
Yeah, absolutely. Yeah, no, it's been a very busy year, particularly the first half of the year. And lots of, what's different is, Canada's got what we call a big company in Canada, might not even make it onto the radar screen here. Like if, $1 billion market cap in Canada is a pretty significant company. And traditionally, a lot of the activism in Canada was in the smaller cap names. And because they're a little easier to target, you don't need as big of a position or an investment from a financial perspective to do something interesting. And B, particularly at the very smaller end of the market, you had a lot of what we call the I want my job back activism, right? Like former CEOs or founders who are now out of the company and are unhappy with how things are being handled, and as they find either on their own or with a partner, just run a proxy contest to try and get themselves back into the mix. What's changed more recently is we're seeing a lot more of the activity focused on the bigger names. And so Algonquin, one good example of that, where we've had TransCanada Pipelines had issues. Like there have been a lot of the bigger names that we're seeing attract interest from the Elliots and their peers of the world.
One more question. Thinking about Europe, we're seeing a lot of activists with extremely small stakes effectuating change, right? So whether it's Bluebell with one share at Solvay or at other names, Bluebell's kind of the case study, but they're only in Europe. I don't think we've really seen that in Canada, have we?
Not a lot, partly because you do have to have, you need the 5% threshold to requisition the meeting, and so that for a lot of people that's kind of the bar for doing something more meaningful. But there are also examples where people with relatively small stakes do start agitating publicly and just trying to attract attention to the situation, put pressure on the board through a letter writing campaign or otherwise, that then may ultimately lead to something more meaningful happening.
Sorry, that was just a great structure. So.
Yeah, I'd be curious, what types of objectives and campaigns would you say are easier in Canada versus the U.S.? And which are harder? Because we talked a lot about these rules, but they have different implications for different kinds of campaigns.
Yeah, I think that the objectives ultimately are the same. So whether it's what we heard about this morning, M&A activism, where people are either trying to oppose a transaction or to extract a better price, the traditional let's change the board. I do think that there is maybe a little bit more of the vote no type activity where people are using majority voting as a tool to, you don't get the full result you want, which is I want our people on the board, but we're very unhappy with these incumbents and we want them gone at the very least. And the vote no strategy is something we see more and more frequently, particularly now that we've got a big chunk of our companies who don't have any exit hatch if the directors don't get the requisite level of support.
Okay, Chris, let's talk a little bit about Europe. So talk a little bit about what kinds of companies you've worked with in Europe and what the intricacies of those campaigns were.
Yeah, look, I think a couple things about Europe. European activism's up almost 50% this year. And the way to think about European activism is 50% is in the UK. We talk about that a bit. And then the next two largest markets are Germany and France. Germany making up about 15%, then France falls to about 7%. The UK is most like the US. So it's, in the US, almost half of all campaigns are for M&A. The UK, it's about 40%. And next would be moving personnel. The difference in the UK, though, is you don't see that much public activity in terms of pushing for board seats. It's much more behind doors. I think that's key. What's a message in the UK market, what we're dealing with a lot with our clients now is considering, depressed valuations and considering redomiciling or relisting in the New York Stock Exchange, for example. When I think about Germany and France, let's start with France. France still is highly regulated. Short selling activities targeted by the regulators. There have been changes. Now there's a say on pay in France. But it's still governance focused, right? And M&A only makes up about 15% of those claims. And then Germany falls in the middle. right? Germany is probably the next hotbed. That's how we view it. You're seeing activity with really large cap names. Bayer would be an example. With real name activists, right? I think that's kind of the frontier. And again, it's still more governance and personnel focused, but M&A is about a third of those campaigns.
Are there types of campaigns in the UK that are easier for activists than in the US?
It's different, right? Because you have the broking rules there, right? So that how you deal with activists is quite different. I think the 5%, we've got a ton of activity after seeing what's happened at ABCAM with folks worried about the 5%. Again, but I still think there's a lot of, it's not easy, right? None of this is easy to requisition at EGM. But I wouldn't say it's easier. I think what's interesting now is that folks view the UK issuers as opportunistic because of the press valuations, and that's driving a lot of discussions.
Is there anything in Germany or France that's easy for activists to do, or is it all just very difficult there?
I think Germany's easier, right? France is kind of, it's still highly regulated. You don't, in France specifically, the activists are mostly from the UK and the US, right? But for the folks like Bluebell who seem to be making some strides, right? But they're kind of leaning in on from a governance perspective first.
All right, last question. Any regulations in these other jurisdictions that the U.S. should adopt?
Well, we could talk a bit about derivatives. Canada, I think, has a much better system than we kind of went halfway there, right, with the recent comments from the SEC and adoptions. But I'm curious your views.
Well, it's been an ongoing discussion, and we've had kind of a number of transactions where the use of derivatives has come into focus, whether that's empty voting or the use of swaps in M&A contexts. So we actually have, much like the SEC has been doing, our regulators have been actively looking at our early warning reporting system and trying to figure out, there has been some reconsidering of the 10% threshold and whether that's too high and whether it should be brought down to 5%, and also the treatment of derivatives. In particular, cash-settled swaps is a real focus. As of now, I don't think it's that different from the U.S. insofar as those types of derivatives are not taken into account when you look at whether you're over the threshold. But once you're in the system, you do have to talk about the entire set of economic exposures to an issuer. We had a very interesting transaction a couple years ago where that the use of cash-settled swaps was front and center. Brookfield made a hostile bid for a pipeline company called Interpipeline, and before they had made the bid, they built a equity ownership position of just under 10%, and also had a cash-settled swap position for another 9%. So they were just under 20% on an economic ownership basis. And after they had built that exposure, then they launched their bid and had made no disclosure about their position up until that point. Once they launched their bid, they were required to sort of open the kimono and disclose the entire position. But the way they talked about it was a little unclear. If you read the details, it was clear that there was 9% stock, 9% swap. But when they issued press releases, they talked about having a 20% position in the company, which became very relevant because the company then, it was a hostile bid, so the company went out and looked for white knights and found a strategic to make a friendly offer that they signed up to, and Brookfield continued to resist it, portraying their position really as a strong blocking position based on having this 20% interest, which there were a lot of concerns about whether that was misleading retail investors in particular as to the likelihood of the friendly deal ultimately going forward. And so there was a whole bunch of back and forth and lawsuits and complaints in front of the regulators. And they made a couple of pretty remarkable findings. First of all, they affirmed that the approach they took to their 13D disclosure was correct, and they had no obligation to talk about their aggregate position under the rules as they currently work until they launched the bid. But they said, notwithstanding that, the way that you use the swaps, the other interesting fact about that was the counterparty on the swaps was Bank of Montreal, and the financial advisor on the transaction was BMO Capital Markets. And so there was a presumption that the swap counterparty may be inclined to deal with the stock in a way that the bidder would like, so that BMO Capital Markets could get their mega fee on the transaction. And so the regulator said, even though you complied with the letter of the law, you didn't really comply with the spirit of the law, so your disclosure was abusive to the capital markets, and you kind of misled people, or at the very least you didn't really correct the misunderstanding people had about how strong your voting position was going to be on the transaction. And so they ordered them to raise the threshold for their bid to basically back out the swap shares, which was it was a very remarkable exercise of regulatory discretion. Ultimately, it didn't matter because Brookfield raised its bid and ultimately did a friendly deal. But it highlighted the tricky issues around swaps, both from a disclosure perspective and from their impact on transactions.
So I have one follow-up. So when we're advising boards, the one thing that we always remind them is that in the U.S., there's no private right of action against those who break securities laws. And the most obvious one that's in the news today is Musk at Twitter, right? He didn't file 13D, and there's a whole lot of reasons and problems with that.
Yeah.
And you've mentioned regulators stepping in. Is there any way in Canada how is this being enforced in Canada?
It's through complaints to the regulators.
So it's the same problem.
So they get very sick of talking to us, because anytime one of our clients is unhappy with a deal, we're calling the Ontario Securities Commission and said, you should really look at this. And please do something to stop this. But yeah, we're similarly situated in that the parties themselves, in most cases, do not have any sort of direct rights of action on these matters.
All right, well, thanks so much. We'll go on to the next panel.